Something is happening in the silver market right now that most people are completely unprepared for. Not because the information is hidden, not because it's complicated, but because the mainstream financial world still refuses to take it seriously. And that gap between reality and perception is exactly where fortunes are made or destroyed. Let me give you one number. One single number that should stop you cold. 46.3 million ounces. That is the projected silver supply deficit for 2026. Not a surplus, a deficit. The sixth consecutive year, 6 years in a row, where the world consumes more silver than it can produce. And here's the part that almost nobody is talking about. That deficit is getting wider, not smaller. It was 40.3 million ounces last year. This year it's 46.3 million. The gap is accelerating, and the forces driving it are not temporary. They are structural, they are permanent, and they are only getting stronger. If you've been watching the silver market and wondering whether the move is over, whether you missed it, stay right here. Because what we're about to walk through isn't about what already happened. It's about what is building right now, underneath the surface, that the market has not yet priced in. And if you're new to this channel, welcome. Hit that like button right now if you want more analysis like this, and subscribe so you don't miss what's coming next. Let's start at the beginning, because the story of silver in the last 18 months is unlike anything this market has seen in a generation. At the start of 2025, silver was trading at roughly $28.92 per ounce. Most analysts had it pegged for modest gains. A quiet year maybe, a slow grind higher. That was the consensus. And then something happened that turned the entire forecast upside down. By October of 2025, silver had shattered its previous all-time record high of $49.95 per ounce, a record that had stood since 1980, 45 years. And it didn't just break that record, it exploded through it. By the end of 2025, silver had climbed to an all-time high of $83.64. And then, in the opening weeks of January 2026, it did something that even the most bullish analysts barely dared to write down. It broke $100 per ounce. On January 26, 2026, silver hit $116.67 in a single session. And just days later, on January 29th, it reached its current all-time record of $121.62 per ounce. From $28 to $121 in roughly 13 months. That is a gain of over 300%. Now here's the thing. Most people see a move like that and think, it's over. The train already left the station. But what if that's exactly backwards? What if the move we just witnessed was not the climax of this story, but the opening act? What if the real shock hasn't happened yet? Here's where things get very interesting. To understand why silver may be setting up for its next major move, you have to understand something that almost nobody in the mainstream financial world talks about. Silver is not just a precious metal. It hasn't been for a long time. Silver is, at this point, one of the most strategically critical industrial materials on the entire planet. And that changes everything about how you analyze this market. Think about every single solar panel being manufactured right now. Solar panels require silver. The conductive paste that forms the electrical contacts on each photovoltaic cell, the part that actually allows electricity to flow, is made with silver. There is no substitute at scale, not yet. In 2014, the solar sector consumed just 11% of global silver industrial demand. By 2024, that number had jumped to 29%. Nearly a third of all industrial silver on Earth was going into solar panels. Now think about every electric vehicle rolling off a production line anywhere in the world. Each one contains silver, in the battery management systems, in the electrical contacts, in the sensors. Think about the artificial intelligence data centers being built at a staggering pace across the United States, Europe, China, and the Middle East. Every server rack, every high-speed transmission cable, every advanced semiconductor. Silver. The Silver Institute, the leading global authority on silver data, released a landmark report in December of 2025. Their conclusion was unambiguous. Solar energy, electric vehicles, and artificial intelligence data centers will drive industrial silver demand higher through at least 2030. This is not speculation. This is the Silver Institute's own formal forecast. And here is the problem. Here is the thing that keeps analysts up at night. The supply side of this equation is not keeping pace. Not even close. Let's talk about where silver actually comes from, because this is where the story gets complicated in a way most people don't expect. The majority of the world's silver is not mined directly. It comes out of the ground as a byproduct of mining other metals, copper, zinc, and lead primarily. What that means in practice is that silver production decisions are not driven by the silver price. They're driven by the price of copper, by the economics of zinc. Silver is secondary. It's what you get on the way to something else. That means even when silver prices are high, even when demand is screaming, the mining industry cannot simply flip a switch and produce more silver. New dedicated silver mines take years to develop. Environmental approvals, capital investment, infrastructure, we're talking about a decade in some cases from discovery to production. The supply response is almost uniquely slow relative to other commodities. And the geopolitical picture makes this worse. Mexico and Russia together account for roughly 21% of global silver production. Mexico has been experiencing increasing regulatory pressure on mining. Russia faces sweeping sanctions and is largely cut off from Western capital markets. These are not small disruptions. These are systemic constraints on two of the world's largest silver-producing nations. Now add one more layer to this. In January of 2026, China, which controls between 60 and 70% of the world's silver refining and processing capacity, implemented sweeping new export controls on silver. Companies now need government licenses to export silver. Only state-approved firms producing at least 80 tons annually and holding $30 million in credit lines even qualify. That regulation, effective January 1st of this year, effectively shut small and mid-sized silver exporters out of international markets almost overnight. Think about that for a moment. The country that controls the majority of global silver processing capacity just made it dramatically harder to get that silver out of the country. And this happened at the exact same time the world is entering its sixth consecutive year of supply deficit. That alone would be a major story, but something else is happening simultaneously that makes this picture even more intense. The London Bullion Market Association, the LBMA, is the world's primary hub for physical gold and silver trading. When analysts want to understand the actual physical availability of precious metals, they watch LBMA inventories. And what those inventories have been showing is alarming. By early 2025, physical silver supplies at the LBMA had already decreased by 30 to 40%. For context, gold inventories at the same institution fell by just 3 to 4% over the same period. Silver was losing physical inventory at 10 times the rate of gold. 10 times. Dana Samuelson, president of the American Gold Exchange, described this bluntly in March of 2025. Silver is, in his words, particularly vulnerable to a supply shock, and he was right. We've already seen evidence of that shock. But here's what most people are missing right now. The conditions that created that shock have not been resolved. In many ways, they have intensified. This is where the situation becomes much bigger than most people realize. Let's zoom out for a moment and look at the demand side from a different angle. Because there is a piece of this story that almost no one in mainstream finance is discussing, and it may be the most important piece of all. We talked about industrial demand, solar, EVs, AI. But there's a second engine driving silver right now, and it's equally powerful: investment demand. The Silver Institute's World Silver Survey, released in April of 2026, made an observation that should fundamentally change how you think about this market. Even as industrial users like solar panel manufacturers began pulling back on silver consumption because prices had risen so dramatically, the overall deficit in the silver market didn't shrink. It grew wider. From 40.3 million ounces in 2025 to 46.3 million ounces in 2026. Why? Because investment demand, retail buyers purchasing physical silver coins, bars, and exchange-traded products, surged to completely overwhelm the reduction in industrial buying. Think about what that means. The silver market right now has two completely separate categories of buyers: industrial users who need silver to build the physical infrastructure of the modern economy, and investors who see silver as a store of value, a monetary hedge, and an asset that is dramatically undervalued relative to gold. Both groups are competing for the same limited supply, and mine production simply cannot satisfy either one of them adequately, let alone both together. Keith Neumeyer, the CEO of First Majestic Silver and one of the most respected voices in the mining industry, said something in an April 2025 interview that deserves to be taken seriously. He said you need triple-digit silver just to motivate mining companies to start investing again. Not to celebrate, not to profit, just to motivate new investment in the supply that the world clearly needs. And here's the part that should make you pause. Even at $121 per ounce, the all-time high, silver pulled back. Not because the fundamentals changed, not because the supply deficit disappeared, but because markets breathe. They surge, they consolidate, they digest. And during that consolidation, the underlying supply-demand imbalance that created the original surge does not go away. Let's talk about what the numbers look like today and what they're projecting for the months ahead. As of mid-June 2026, silver is trading in the range of $75 to $80 per ounce. That is a significant pullback from the January highs. And for most financial commentators, that pullback has been framed as evidence that the silver story is over. The correction proves the bubble burst. Move on. But wait, is that actually what the data shows? JP Morgan projects silver will average $81 per ounce in 2026, more than double the average of 2025. The Silver Institute confirms the market is in its sixth consecutive annual deficit. Physical retail demand is surging, with buyers actively hoarding metal. LBMA inventories remain under strain. China's export controls are still in effect. Mine supply is still structurally constrained. Not one of those fundamental factors has improved. In fact, several have worsened. Here's a detail that almost nobody is talking about. Retail demand for physical silver coins and bars is so strong right now that it's creating what analysts are calling a liquidity squeeze. Dealers are reporting difficulty sourcing physical metal at spot price. Premiums, the amount buyers pay above the paper spot price, remain elevated, which is a market signal that physical metal is harder to obtain than the quoted price implies. When premiums are elevated, it means the real-world price of silver, the price you actually pay to hold the physical metal in your hand, is higher than what the financial charts show. That gap between paper price and physical reality has historically been one of the early warning signals of a coming price reset in the spot market. Now here's the detail most people miss when they see a chart like silver's. Silver's price history is not smooth. It has never been smooth. It moves in explosive bursts separated by sometimes brutal consolidations. And those consolidations are almost universally described as the end of the rally by mainstream analysts, right up until the next explosion higher. Look at what happened after the 2008 financial crisis. Silver moved from roughly $8.50 per ounce in 2009 to $50 per ounce in 2011, a 500% rally in 2 years. And then, seemingly out of nowhere, it was crushed. The Chicago Mercantile Exchange raised margin requirements 5 times in 9 days. The price collapsed, and everyone said it was over. It wasn't the end of silver's long-term story, it was a chapter. Look at what happened when silver broke from $28 at the start of 2025 to $121 at the end of January 2026. That move looks enormous on a chart, and then it pulled back towards $75. The mainstream took that as confirmation, bubble popped, story over. But the Silver Institute says the 2026 deficit is wider than 2025. Investment demand is growing, not shrinking. Physical retail demand is at historic highs. Mine supply is still constrained. China's export controls are still active. If the bubble truly popped, where did the supply deficit go? It didn't go anywhere. And this is the core insight that separates the people who understand silver from the people who are watching it from the outside. Price is not the same thing as value. Price is what the market agrees to trade at in a given moment. Value is what the fundamentals, supply, demand, geopolitics, monetary dynamics, actually justify. And when price disconnects from value in a commodity with a genuine structural supply shortage, history shows what happens next. Let's talk about the gold to silver ratio for a moment, because this is one of the most powerful tools for understanding where silver stands relative to its historical norms, and what that historically implies about future price moves. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, going back centuries, that ratio has averaged somewhere between 15 and 20 to 1. This is roughly how much more common gold is in the Earth's crust relative to silver. But the modern financial era has seen that ratio stay dramatically elevated, sometimes reaching 80, 90, even over 100 to 1. When the ratio is high, it means silver is cheap relative to gold by historical standards. And historically, mean reversion, the return toward normal, has been one of the most reliable features of the gold-silver relationship. Even after silver's enormous move, the ratio has been compressing, meaning silver has been gaining ground on gold. But if you look at where the ratio stands today versus historical norms, the analysis suggests silver still has significant room to outperform gold, even from current levels. Not because gold is going to fall, but because silver, at a fundamental level, is still undervalued relative to what the historical relationship between these two metals implies. Maria Smirnova, Senior Portfolio Manager and Chief Investment Officer at Sprott Asset Management, one of the world's most respected precious metals investment firms, raised concerns about the silver supply deficit in interviews with the Investing News Network. Her concern was not short-term, it was structural. The kind of deficit the silver market is experiencing is not resolved in a quarter or a year. It compounds. And that is the word that matters here: compounding. A supply deficit of 46 million ounces sounds like a big number, but let's contextualize it. Global silver supply is roughly 1 billion ounces per year. A 46 million ounce deficit represents roughly 4.5% of total annual supply. That might not sound enormous, but consider this. That deficit has been accumulating for 6 years. 6 consecutive years of the world consuming more silver than it produces. Where does that silver come from? It comes from above-ground stockpiles. It comes from vaults. It comes from existing inventories. But those inventories are finite. They do not regenerate. And the data from the LBMA shows they are already significantly depleted. This is not a theoretical future risk. It is a present-tense reality. And as inventories continue to be drawn down year after year with no resolution to the supply-demand imbalance, the pressure on prices does not release. It builds. At some point, and history gives us no clear formula for exactly when, the tension between supply and demand reaches a breaking point. And when that happens in a commodity market with genuine physical scarcity, price moves do not happen gradually. They happen in sharp, dramatic, sometimes stunning bursts that catch the majority of market participants completely off guard. We've already seen one of those bursts. The question the market is sitting with right now is whether we've seen the only one, or the first one. Drop a comment below. Tell us where you think silver is headed from here. Are you in the camp that says the peak is in, or do you think the structural fundamentals are still building towards something larger? We read every single comment and we want to know what you think. Now let's bring in one more dimension of this story, because we haven't yet talked about the macroeconomic backdrop, and that is a critical piece of why the silver setup for the second half of 2026 looks the way it does. Silver, like gold, is a monetary metal. It has been used as money for thousands of years, and in the modern financial world that means it responds to interest rates, to inflation expectations, to the strength of the dollar, and to the perceived stability of fiat currency systems. Look at what's happening with monetary policy. After years of aggressive rate hikes to fight post-pandemic inflation, the Federal Reserve has been signaling a pivot toward lower rates. Lower real interest rates, rates adjusted for inflation, are historically bullish for precious metals. When real rates are negative or near zero, the opportunity cost of holding physical silver, which pays no interest or dividend, effectively disappears. Investors are not giving up much by choosing silver over bonds when bonds are barely keeping pace with inflation. At the same time, the United States, along with most major economies, is running historically large fiscal deficits. Government spending continues to outpace tax revenues. Debt levels are climbing. And debt levels at scale, historically, have one primary resolution mechanism: inflation. The gradual erosion of the real value of the debt through a debasement of the currency. Silver, as a physical, tangible, limited asset, is a direct hedge against exactly that process. This is why you're seeing sovereign wealth funds, central banks, and institutional investors increasingly paying attention to precious metals. It's not about doom, it's about portfolio positioning in an environment where the traditional safe haven, government bonds, is no longer providing the same level of protection it historically offered, because the governments issuing those bonds are the source of the instability. Here's where the situation becomes even more consequential. The United States, facing concerns about domestic industrial supply chains, has been making a quiet but significant strategic move. Earlier in 2026, the country dramatically increased its silver imports, 7,600 metric tons, compared to 4,430 metric tons in the prior year. That is a 70% increase in silver imports in a single year, not from consumers, from a government and institutional level. When a country with the world's largest economy is importing 70% more silver in a single year, that is a signal worth paying close attention to. It reflects an acknowledgement at a policy level that silver is strategically important enough to secure supply proactively rather than rely on the market to provide it on demand. Alex Abkarian, co-founder of Allegiance Gold, was direct about what this means. Yes, there are structural deficits. Yes, demand exceeds available supply. The move to secure domestic silver supply reflects that long-term reality. And here is the thing that ties all of this together in a way that should make the picture very clear. When governments are importing silver at record pace, when the Silver Institute confirms the 6th consecutive annual supply deficit, when LBMA physical inventories are severely depleted, when China has restricted silver exports, when investment demand is surging at the retail level, when AI data centers and EV manufacturing and solar installations are all competing for the same industrial silver supply, the question is not whether silver's fundamentals are bullish. They clearly are. The question is timing. And timing in commodity markets is almost never predictable with precision. What is predictable, with high confidence based on historical precedent, is that a multi-year accumulation of structural supply pressure does not resolve quietly. When it resolves visibly. Let's bring this home. Let's zoom back and look at the full picture, because every thread of this story connects to a single conclusion that I want to make sure is crystal clear. Silver is a market where the physical supply has been in deficit for 6 consecutive years, with that deficit widening, not narrowing. Industrial demand from 3 of the most powerful secular growth trends in the global economy, solar energy, electric vehicles, and artificial intelligence, has structurally elevated consumption and is projected to continue doing so through at least 2030. Investment demand is surging at the retail level, creating a second category of buyer competing for the same limited physical supply. China's new export controls have tightened global physical availability of refined silver. LBMA physical inventories have been dramatically depleted, down 30 to 40%, while gold inventories fell by only 3 to 4%. Mine supply is structurally inelastic, meaning even high prices cannot produce a rapid supply response. The macroeconomic environment, with potential rate cuts, elevated inflation, rising fiscal deficits, and a weakening dollar, is historically favorable for precious metals. The gold-to-silver ratio still suggests silver is undervalued relative to historical norms. JP Morgan projects silver to average $81 per ounce in 2026, and that assumes no further supply shock. And the United States is importing silver at a pace 70% higher than the prior year, signaling strategic concern about supply access at the highest institutional levels. That is not one bullish data point. That is not a speculative narrative built on hope and hype. That is 9 separate, verifiable, data-backed structural factors, all pointing in the same direction simultaneously. The silver market does not always respond immediately to fundamentals. Markets often move slower than the fundamentals demand. But when they move, when the tension that has been building finally releases, they do not move in small, orderly steps. They move in the kind of sharp, dramatic bursts that leave most observers in disbelief. We've already seen one of those bursts, from January 2025 to January 2026. From $28 to $121. But the structural imbalances that drove that move have not been resolved. In several ways, they have deepened. And the current consolidation, the pullback from the highs, does not represent a resolution of those fundamentals. It represents a pause while the market catches its breath. The question for every person watching this video is not whether silver's story is over. The data says clearly that it is not. The question is what you do with that information. Here is the thought I want to leave you with. The most powerful investment opportunities in history are almost always the ones that most people walk away from too early. They see a move, they assume the move is finished, they move on, and then they watch from the sidelines as the next phase of the story unfolds without them. Silver's story in 2025 and early 2026 was dramatic enough to get attention. The pullback from those highs has been dramatic enough to make most people assume the story is over. But the Silver Institute says the deficit is wider this year than last. JP Morgan says prices will average well above current levels through 2026. Mine supply cannot respond rapidly. China has restricted exports. Investment demand is at historic highs. The structure of this market has not changed. The narrative around it has. And that gap between narrative and structure is exactly where the next shock is being built. If you found this analysis valuable, please share it with someone who needs to hear it. The information in this video is not widely discussed in mainstream finance. The more people who understand what's happening in the silver market, the better positioned they'll be for what may come next. Drop your thoughts in the comments. Where do you think silver goes from here? What's your target? What's your biggest concern? Let's have that conversation below. And if you're not already subscribed to Gold and Silver Intelligence, now is the time. Hit that subscribe button and the notification bell so you never miss an analysis like this one. We cover the gold and silver market with the depth and precision that this asset class demands. Because in a world where most financial coverage is surface-level noise, you deserve analysis that actually means something. Silver has already shocked the market once. The fundamentals say it isn't finished. The only question is whether you'll be watching when it does it again, or participating.